I'm Amy Price. I am the COO for the U.S. business of Bentall Kennedy, and we do a lot in multifamily, so happy to give you a quick perspective on that market. I'd say there's a lot of, actually it's timely because there's a lot of discussion about multifamily and what's going on in that space today. I think our view may differ a little bit from others in that we probably see a little bit more runway and opportunity that remains within multifamily as compared to some others. Specifically, I think there's a lot of talk about the supply of multifamily, and we obviously focus on that, but the other side of that is obviously the demand story. And I think we really look at demand, we look at household formation and see opportunities where we still think demand is outpacing supply, albeit supply is occurring at a robust pace. So I'll give you one example, which would be the Chicago market. We actually have a multifamily development project in Chicago called Hubbard Place, and we undertook that because we looked at Chicago, and while over the last decade household formation overall declined for the city of Chicago, it increased at about a 35% rate in the urban core. So it's a very different trend. So looking at opportunities to understand micro markets and understand, again, both the supply and demand stories and invest into that is what we're focused on with multifamily. So industrial as an asset class, I think, is interesting. Just to frame it, industrial, I think, is very different from other asset classes in that it is not easily renovated or rehabbed or repositioned. So you really need to look at the existing space of industrial and decide whether you think it works for the tenants of today and somewhat the tenants of tomorrow. So for that reason, we're very focused on opportunities to invest into really what we consider the best product today, which is generally warehouse distribution, close to major population centers with the physical characteristics that distributors are looking for. Case in point, we recently acquired an asset in the Alliance market of Fort Worth, where it's a 1.1 million square foot box and it's an Amazon lease. And we believe that those type of opportunities to invest in, again, brand new buildings that are serving e-commerce and trends and tenants that are going to continue to drive demand for warehouse product and distribution, kind of again over the next, call it 10 years, are really priorities for us and where we want to focus our efforts. I think clearly there's a ton of demand coming from capital today to invest into real estate. It is hard to find opportunities that work. So for us, I think what's important is focusing first on finding those opportunities that you think fit the metrics of what you're trying to accomplish, and then be more open and more flexible about different structuring alternatives for the investment. So for example, even within some of our development projects, we have structured our investment as equity, as preferred equity, as mezz debt, as participating debt, but really trying to work with a developer and operator to come up with a structure that works best for them and best for us in terms of risk return and, again, what they're trying to accomplish. So I think really having flexibility in deal structure is important. The other point I'd say there is that looking at some other alternative asset classes is also another way to kind of differentiate yourself and look for other opportunities today. And one of those areas for us is medical office. And we're spending a lot more time looking at both acquisition and investment and development opportunities within medical office.